If you do a 5-year draw, it's a little bit higher of a rate because it essentially gives you more time to play with the money. 7-year, a little higher, 10-year, even higher. Pretty typical. Now, a HE loan is a little different, where it's a fixed balance, it's a fixed payment. The payment doesn't change regardless. If you and it's not a credit line. It's basically like a second mortgage, a closed-ended second. So another name for a HE loan is a closed-ended second, where it's basically just like your first mortgage, except it's a second mortgage, an additional payment that you're making. It's not a line of credit, so whatever you take out at closing is what you have, and that's it. It doesn't change. And the only thing that you can do at that point is make payments on it and pay it down, just like your first mortgage. Now, those types of loans are honestly, well, it depends on the situation, but I often find myself having borrowers that are more interested in that loan type because those rates are generally a little less. They're usually 1/4 to 0.5% better, sometimes more than that, than the HELOC rate. Now, although you lose a little bit of flexibility, it is a fixed rate, it is a fixed payment, you know your balance, and it's very simple. Whereas a HELOC, the first 3 years, you're really only required to make a minimum payment. An interest-only payment is what we call it in the HELOC world. So it's kind of like a credit card where, when you get a credit card, you take out a balance and you see your minimum, my minimum payment is only $85. Well, in reality, if you're only paying the minimum payment, you're only paying interest. So you're essentially paying 100% interest. The thing that's cool about the HELOC is that it does give you that flexibility. If there are a couple months where you can only, you only have to make the minimum payment. I always encourage my borrowers to pay above it to actually make progress, but it just depends on the client's situation. Everyone has a different need, everyone has a different circumstance, and that's why there are those two options. HELOC, home equity line of credit, where it's a line of credit you can use for a set period of time called the draw period until it turns into the repayment period.